Hello, everybody. Today is August 15, and welcome to our monthly market analysis. And happy Independence Day to all my Indian friends. Today's market analysis will be action packed as a lot has been happening in the markets. Some of you may have seen your portfolios dip by 30 to 40%, while others who know how to invest in the market may have been able to pick up your target stocks in the last couple of weeks and already seen your accounts grow. Today, I'm going to speak about the causes of these disparities in your portfolio. But before we get going, please pause this video. Folks, I'm not selling anything, and anything that I'm about to tell you or share with you based on my views alone and based on my research. So with that said, let's get going. Since July 17th, the market has taken a dip, and the dip has basically been accelerated since the 1st of August. Prior to that, the market was going down. And as of August 15, the S&P 500 had gone down by 9.7%. And S&P 500 represents a collection of 500 largest companies listed in the stock exchanges in the United States. NASDAQ, that has more than 3,000 companies, mostly in the technology sector, ended up dipping during the same time by 15.7%. And Russell 2000, which represents small to mid-cap companies, went down by 13% during the same time, which is by August 5. Now, we can't forget crypto. But as we all know, crypto is very volatile. So since July 29, Bitcoin went down by a whopping 29. But as you can see, Bitcoin has been actually on a downward trajectory since March last year, right? So it's been consistently going down. So any of you who had invested in Bitcoin after March and were hoping for Bitcoin to grow in the long run, so far this year, since last year, you would have seen your portfolio not do too well. So if your portfolio was heavily into Bitcoin, then recently your portfolio would have taken a big dip. And this is because of the heavy volatility these kinds of cryptocurrencies observe. Now, I don't personally like to invest in Bitcoin because Bitcoin is not a productive asset. My philosophy is to invest in productive assets. So what is a productive asset? It's any asset that produces anything. Like Apple produces Apple phones, Microsoft produces software, but Bitcoin doesn't produce anything. Bitcoin is basically going up and down based on the perception of people of its supply and demand. Now, very similar thing happened to Ethereum as well. So since July 22, Ethereum ended up dropping by a whopping 40% until August 5th. But also similar to Bitcoin, Ethereum has also been regularly and continuously going down since March last. Now, clearly something's been happening in the market, right? That has brought so much volatility. So what are these reasons? First reason is that last week, US job data for July came in and the unemployment rate increased by 0.2% and ended up at 4.3%. Now, I understand that over the last little while, it was slightly going up, but this growth was above analyst expectations. And when that happened, obviously the market overreacted. But there was a study that just came out a couple of days ago by Fitch. And Fitch said that the jobless rates were largely driven by workers joining and rejoining the labor force rather than any meaningful job losses. And permanent job losses are still contained, only making up less than 20% of the increase in unemployment rate. That means the permanent jobs are actually still looking pretty good. Now, while hiring rates have slowed down meaningfully, layoff rates remain at an all-time low over the last 20 years. This means that the unemployment rates or the layoff rates have actually been quite low, which is a good sign. Now, this ended up triggering an indicator called Sam's recession indicator, which in the past has been accurate predictor of the recession by what? One. So when this got tripped this time, people were obviously panicking. They're like, what's going on? So here's a SAM indicator that you can find on the government website. And basically, this is an indicator that shows the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5% points or more relative to minimum of 3-month averages from the previous 12 months. But this time, this indicator was triggered by an increase in labor supply rather than unemployment rate, making this a false positive. And when Claudia Sam herself was asked about this last week, here's what she had to say. She said that our understanding of what is happening right now is so very challenged. And what that means is, and I'll be the first to say, as it is someone who has a name attached to her name, don't just rely on one tool. So she's saying, don't just rely on one tool. And she also says, we are not in recession now, contrary to the historical signal from the SAM's rule, but the momentum is in that direction. So this is what she's saying. And she also says a recession is not inevitable and there is a substantial scope to reduce interest rates. So she's actually giving the formula that yes, this although this may be a false positive and a recession may not be inevitable, but she's saying the way to turn this around is curbing the interest rates. Now, if there is a recession, you can't just depend on one indicator. Similar to what Claudia was saying, we got to look at a whole bunch of things. So the first thing that you look at when you're thinking whether there's going to be a recession is the GDP. So how has the GDP been? The figures came out for quarter two. Before quarter two, as the GDP of the United States was slowly going down, but something happened in Q2 that the GDP increased. So when you have an increasing GDP, that by the book indicates that it's not a recession. So with an increase last quarter, the fears or actual numbers that relate to whether it's going to recession are not there. Also, in Q2, the GDP grew to a 2.8%, while shrinking over the previous 3 quarters that I showed earlier. Now, I'm also going to show you these charts that show what happened with inflation in 2021. In 2021, inflation started to increase, right? As you all remember, inflation was increasing. And this led to a rise in prices of goods and services. And why did that happen? Because the interest rates were practically zero. So there was so much money available in the market that people could take that cash, borrow the money, invest in businesses or investments, or take vacations or buy furniture or buy homes or whatever that may be. So because there was so much demand, because of so much free money was available, and the demand kept increasing, when the demand increased, the people who are selling those products say there's a lot of demand, so let's increase the prices. When the prices go up, that basically means the inflation goes up. So this is what was happening up until 2022. And this is where the feds came in because they have a couple tools in their tool set to be able to control inflation. Because one of the main jobs that Federal Reserve does is to make sure that the economy is not too hot, not too cool, and it grows perfectly. So feds came in and they wanted to curb the inflation. So one of the things they employed was an interest rate. So they grew interest rate. Now, interest rate had been this high in the past, but what happened this time was that interest rate grew at its fastest pace in history. This is what spooked investors. So as the interest rate continued to increase, what that did was small companies that are able to not survive on their own and have to depend on borrowing money could not afford debt. So they started reducing the amount of debt they had to take from the banks. And as that went down, these companies no longer had brand new money available to spend on new programs and projects. And therefore, they either froze their hiring or they started to let go of. Now, this made employees and other people nervous, which basically encouraged them to not go and spend as much money in the economy. So as the demand for things went down, which means as these people started spending less and the demand for things went down, then what happened? The inflation went down because the supply of goods goes up. So the sellers in the market say nobody's buying our product, so let's bring the prices down. So consequently, the inflation started to go down. And as the inflation started to go down, the U.S. Federal Reserve started to basically come to an end of their hike of interest rate. So they stopped at 5.25% to 5.5%. So that's where the interest is currently. Now, what's happened now is that inflation has started to come down to the goal of the Federal Reserve, which was 2%. So while it's not 2%, as of, I think, today or yesterday, the annualized inflation has now reached somewhere close to 2.8%, which is fantastic. Remember, the goal is to bring the inflation down to 2%. So as of today, the latest CPI numbers came in, and while the CPI grew this month to 0.2%, last month it had hit negative, and the month before it was zero. The overall trend of the CPI, which is monthly, is on a way down. Again, even though this month, in the month of August, so today the numbers that came in for July are at 0.2%, overall, the annualized inflation has continued to go down. As of today, the annualized inflation is showing to be 2.9%. Remember, I said the Fed's goal is to bring this to 2%. So they're very close. Now, the market is now starting to indicate that maybe the Feds have taken too long to cut the interest rates. And I believe if the unemployment figures that came in a couple of weeks ago for the month of July had come in a few weeks prior, then in the month of July, when the Feds had their FOMC meeting, they may have decided to cut the interest rates right then and there. But now it has come like a couple of weeks ago, and market did react. Feds are now thinking that the chances of them cutting interest rates are going up. And I'm going to discuss those in a few slides, what the forecast is for the Federal Reserves to cut their interest rate. Today, also on August 15th, the latest retail sales figures are in for the month of July. Now, based on this, there was a 1% growth in the retail and food service sales since June, and, and up 2.7% since June of last year. And these are great signs that show that people are developing confidence in spending and the chances of recession are not that strong. And because these figures came out uh, and the fear of recession has eroded as of today, look at what has happened in the S&P 500 today. So here is S&P 500, and this is, notice this jump. So S&P 500 has just taken a huge jump today because of these figures that have come in. Why? Because the fear of recession is starting to grow. Now, I personally am not fearful because of many other signs that I have spoken about, and I'll also continue speaking. But stock market or the retail investors in the short term are highly emotional. So they get charged up and overreact to the smallest little news that comes in. And also, it's important to note that yes, the jump has happened today, but the companies whose stocks have gone up, has there been any change in those companies for the last 2 weeks? No, their revenues have been the same as the profitability. So what has caused to this sudden volatility? So that this drop and rise in the stock market, it's just overreaction. And I always say that the stock market is highly temperamental in the short term, but in the long run, it comes and reaches its intrinsic values. Now, another reason why the stock market dipped recently was due to Japanese yen. Japan, as you know, is one of the major economies in the world with a strong banking system. But did you know that the interest rates of Japanese yen have been close to zero since 2008? And what a lot of people used to do is recognizing that the US market was very strong and the money was so cheap, essentially free in Japan, they would borrow money from Japan and spend it in the US market, and it basically invested in the US equity and bond market and also the crypto market. So as US carried on growing and Japan was not charging much interest rates or almost practically zero, if people were borrowing money from there was a huge arbitrage opportunity. Now, what that ended up doing was because the money was so easily available in Japan, similar to the United States, that's what was happening prior to 2022, because of this free availability of money, people were just taking the money and spending and growing wherever they want. Consequently, the consumer price index, which is the monthly form of annualized inflation, kept growing. Or in other words, the inflation in Japan kept increasing. So Japan, the government of Japan said, you know what, I think we need to do something to curb inflation. So they decided on July 31st that they're going to start increasing the interest rate. So on July 31, when they decided, guess what happened in America the next day? In America, those people, or a bunch of those people, investors who had taken money from Japan and were investing in the United States, realized that the arbitrage opportunity that existed was no longer going to be there. So they started pulling their money from the US stock market, US crypto market, US bond market, and all those started to go down. Consequently, this occurred right on time and right on cue on the 1st of August. This spooked the investors. And one of the big things that got affected was extremely high volatile indexes and volatile investments. So NASDAQ, which is more volatile than the S&P 500, had a bigger move or a bigger drop in its performance after 1st of August. And the crypto market had an even bigger drop after the 1st of August because it's just volatile and people just start to pull money. And what happens is when people pull money, because most of the investments and tradings are done by algos or bots, especially those from different hedge funds and institutional investors, their bots got triggered that why is so much money being removed? They start selling their positions, leading to a ripple effect in the stock market. That's why suddenly there was so much money that was lost after August 1 and continued till the 5th of August. Now, in 2022, Feds raised interest rates at its fastest ever to defeat inflation. But now that inflation is on its downward trend, the central banks can remove the brakes and press on the accelerator by lowering the interest rates. Feds are now, folks, looking to cut interest rates. I personally think there's potential for 3 cuts, but definitely there are 2 cuts coming this year. If the unemployment rate remains high, as it did in July, then that could deteriorate other economic indicators like a slowdown in consumer spending, and that could lead to the Fed's deciding to cut 50 basis points. And that could potentially continue to become a base case if the economic indicators don't remain. But what's important to recognize right now is that the interest rate cuts are coming. And after 2024, at least I think three rate cuts are available or possible. So one, two, three. And then thereafter, the rates continue to go down until 2026 or late 2026, where the interest rates have a potential of going below 2%. Now, we'll wait and see what happens, but at least this is what the market is starting to show signs for. Here is what the Fed Watch tool is saying. Currently, the interest rate is between 5.25 and 5.5%, right? 5.25 and 5.5%. As of September 18th, which is when the next FOMC meeting is going to be held, the chances of them cutting their interest rates to 500 basis point to 525 basis point has now jumped as of today to 74.5%. This will bring in September a rate cut of 0.25%. Now, fast forward by 2 more months. In November, there is a potential of another 25 basis points to 475 to 570. So that's also a good sign. Now, fast forward again to December, there is again a rate cut potential of a 425 to 450 basis point. This is going to bring this rate cut to 1% less than what it is today. So this is all the good news for people who have potentially variable interest rates on their homes or are looking to borrow money. A 1%, depending on the face value or the principal you're looking to borrow, or may have borrowed for the purposes of your properties, can start to show significant reductions. Canada, for instance, already foresaw an upward trajectory and a good performance in the economy, and in June had already started to cut their interest rates. So Canada ended up cutting their interest rates by 0.25%, which is 25 basis points, which the United States is now looking to follow in September. So these are good signs. Now, this brings us to the next point, which is how do we think the markets are perform this year? Now, ultimately, folks, nobody has a crystal ball. There are all kinds of studies that are available, which I even keep bringing in my previous webinars. But what's important to note is we can look at some probability and statistics and see how markets have performed in the past. Of course, historical performance is not a guarantee of future success, but at least for our entertainment purposes, we can have a look at what we have available in front of us. So I have a study that shows that since 1950, how did the S&P 500 perform on all election years? What we notice is the summer time frame is a time frame of volatility. And this is a time when market goes up and down, and we've already been noticing that. And this volatility continues till just before elections occur. And elections are typically held in the first week of November, right? After that, the market goes up and then follows what's called the Santa Claus rally. So far, we've been seeing very similar. Now, again, these are averages. They're not exactly how the market is going to be, right? So, for instance, based on averages, the first week of August is supposed to be strong, whereas in our case, the first week of August was low. But this could be that maybe what was supposed to happen in the last week of July, maybe that happened in August, or what was supposed to happen towards the end of the summer happened now. These are things nobody knows. But what's important to note is there is summertime is typically a time of volatility. It also coincides with people taking vacations. So people are not really out there spending money in maybe non-vacation items. So from that point of view, it makes sense. But it's important to note that for us as long-term investors, this time frame of the summer gives us many opportunities to invest in great quality companies. I had very little opportunities this year to invest. I was able to invest maybe a little bit of money earlier this year. Then throughout the year, I almost had no investments until last week when the market dipped. Many of my stocks are below their fair market value, so I was able to enter. And then since then, the market has gone up, so I'm a happy person. What you got to remember is as long-term investors, you got to be able to identify either stocks of great quality companies by doing intrinsic value calculations, and there's a whole process to it. So that process is very important. Or to simply invest in the market, which is the S&P 500, the NASDAQ. These are amazing ETFs where diversifications are already there. And you have professional money managers who are managing the money. As long as you do regular investment, dollar cost averaging, and don't over allocate to any one place, you know what, chances of you getting the same kind of returns as the market does are pretty high. And the market in the long run goes up. Another reason for market distress could be attributed to the uncertainty in how US elections could turn out. Remember, the stock market does not like uncertainty in the short term. And until very recently, it was looking like Mr. Donald Trump was going to be a clear winner of the US presidential election. But ever since Kamala Harris came in the picture, the certainty of Donald Trump winning the elections has eroded. Now, I'm not saying whether Kamala Harris is going to win or Donald Trump is going to win. I'm just saying the certainty of a clear victory or high chance of victory of Donald Trump has eroded. And again, remember, stock market does not like uncertainty. So this could be another reason. But we as long-term investors, we can look at the history of the past performance and see statistically what happened to the stock market under the leadership of a Democratic president or a Republican president. I have a chart that shows the performance of S&P 500 since the year 1957 and how the stock market or the S&P 500 performed. If you notice that under a Republican president, the S&P 500 returned on average 7%. Whereas under the leadership of a Democratic president, the S&P 500 returned 11.4%. So again, I don't know who's going to win, but even if the Democrats win, which may not be what everybody was expecting earlier, you know what? The stock market has a higher chance of doing better. Ultimately, this is all entertainment purposes. Ultimately, you know what? No matter who wins, the market is going to go up. You just have to remember that the stock market goes up or the prices of stocks go up to ultimately reach the fair market values of those stocks. And the fair market values of stocks are calculated using the company's performance or their earnings. I have a chart in front of me that's produced by FactSet. It's called the Earning Insight, and I have the Quarter 2 2024 scorecard, which shows how the companies in the S&P 500 perform in different sectors and in general in S&P 500. Anything that's in green shows the number or percentage of companies that beat analyst expectations. Anything that's with yellow shows the percentage of companies that met analyst expectations, and anything that's in red shows companies that did not meet analyst expectations. So you'll notice, I'll bring your attention to the S&P 500 area here, which shows that 76% of the companies or 78% of the companies were able to beat analyst expectations. 6% of the companies were able to meet analyst expectations. And if you add those up, that's 84%. So that means 84% of the companies were able to meet or beat analyst expectations, whereas only 16% of the companies did not meet or beat the analyst expectations. Now, that's a great sign, right? Majority of the companies are meeting expectations, if not beating them. That means their earnings are higher and continue to grow. And if the earnings continue to grow, that means in the long run, the prices of their stocks are going to grow. You just need to know how to invest in those or invest in the whole ETF, which is NASDAQ, for example, or the S&P 500. Now, I want to bring your attention closer to each of these to show you how different sectors have performed. So all these different bar graphs that we have, these represent different sectors. So first sector is healthcare, which had the best performance. So over 90% of the company analyst expectations. Then came real estate, then industrial, then financials, then utilities, then materials, then information technology, then energy, then consumer staples, then consumer discretionary and communication services. So pause this, go through this and get to understand. You can even research FactSet and look at the earnings and get to better understand what the performance were. Now, lastly, we have to remember how the market typically behaves. The market never goes up in a straight line. You'll never see the stock market going up. Instead, the stock market goes up like this, goes up and down and up and then down and up and down. In essence, stock market or the stocks of a company either are sold at an increasingly high rate, which is a crazy price, or at an increasingly low price. Perfect markets are only in textbook. This is what actually happens in real life. I have a table here that shows how many times these dips actually occur. I think this is a very important table for every one of you to remember. Folks, a dip of 5% to 10% is called a dip. And this happens about 3 times. The average duration of this kind of dip is 43 days. Next is 10% to 15% is called a correction. This happens about once a year, lasts for about 110 days. A severe correction is between 10 to 15%, and this lasts for about 251 days. And then we have the bear market. Bear market is anything when the stock market goes below 20%, and this happens once every 6 years. Now, remember, we've just come out of a bear market, and these durations that have been provided, which are average lengths, these are averages which also take into account the dips that happened in early 2000. So those are long dips. These kinds of dips I have not been noticing lately, but again, these are good to remember. As long-term investors, it's important for us to understand that just because the market is going up doesn't mean it's going to continue going up. Remember, market never goes up in a straight line. It's wise for investors to wait on the sideline, wait for the stocks to reach their level or the ETFs to reach their buy levels, and don't just deploy money based on hype of what's happening in the market or what somebody told you in a bar. Stick with your rigorous investment process. And if you don't know how to invest in the stock market, contact me, join me on my free Facebook group, which is Amit Chandan Financial Knowledge. With that said, thank you very much, and I hope to see you next. Bye bye.